What did we learn this summer? There are three topics we wish to highlight, which we believe are essential to understand market direction. Topic number one, economic recovery across advanced economies. Topic number two, the Fed supportive communication after the sell-off, which happened in May and June. And third, continued weakness across emerging markets. Let's start with topic number one. Whether you look at the US, the UK, Japan, or even the Eurozone, recent data have surprised on the upside, sometimes quite significantly. There is little doubt that since 2008, we have, for the first time, a synchronized recovery. In the case of the Eurozone, we rather speak about a stabilization because structural headwinds remain. At the same time, the US economy is on a path toward 3% growth, and 3% growth would be consistent with the Fed starting to remove extraordinary accommodation. Now we are already switching to topic number two. You will remember that the disclosure of the Fed of its intentions to remove accommodation triggered a sharp sell-off across financial markets back in May and June. Just after that, Fed officials were at pain to reiterate their commitment to accommodative monetary policy. And crucially, Chairman Bernanke stated explicitly that tighter financial conditions, read higher interest rates, were unwelcome if they started to have a negative impact on the economy. This is a very important statement. Third, broadly speaking, emerging economies have continued to disappoint. Some problems are homemade, as countries like Brazil or India missed the opportunity to reform their economy as capital was freely flowing into these countries. And more generally, as dollar rates are becoming more attractive, now we see capital flowing out of emerging economies, putting pressure, sometimes substantial pressure, on their currencies. There is one big exception, though. China has started to release good economic figures, showing the commitment of the leadership to maintain a minimum 7% growth rates, even if we believe that the recipes they use are not sustainable. Given the recovery in the West and Japan, stabilization in China, we expect emerging market economies to stabilize at some stage during the second half of this year, or at the latest in the first half of 2014. What did we do over the summer? During the first half of July, we reinvested a substantial portion of our cash into developed equity markets, high-yield bonds, and emerging market bonds denominated in US dollar, moving back to an overweight position toward risky assets. We also added to our gold positions as we considered the huge sell-off being exaggerated, and we considered $1,200 per ounce as a natural floor for gold, as it corresponds to the marginal cost of production. September will be a month with higher volatility. We have the resumption of the debt ceiling discussion in the US, German elections, question mark behind the ruling coalition in Italy, and most importantly, the escalation in the Syrian conflict. That being said, we do not believe these events will derail the recovery and our constructive stance toward risky assets.